Brad Williams, Frugal Finance, Eurodollar and T-bill futures. Previously, we considered some hedging strategies. In this course, we'll look at alternative risk management strategies using short-term interest rate futures. We proceed by considering a series of examples taken together. These examples provide a handbook of techniques for a variety of risk management strategies. All of these strategies turn on protection against shifting interest rates. Changing the maturity of an investment. Many investors find themselves with an existing portfolio that may have undesirable maturity characteristics. For example, a firm might hold a 6-month T-bill and realize that it will have a need for funds in 3 months. By the same token, another investor might hold the same 6-month T-bill and fear that those funds may have to face lower reinvestment rates upon maturity in 6 months. This investor might prefer a 1-year maturity. Both the firm and the investor could sell the 6-month bill and invest for the preferred maturity. However, spot market transaction costs are relatively high, and many investors prefer to alter the maturities of investments by trading futures. The two examples that follow show how to use futures to accomplish both a shortening and lengthening of maturities. Shortening the maturity of a T-bill investment. Consider a firm that has invested in a T-bill. On March 20, the T-bill has a maturity of 180 days, but the firm learns of a need for cash in 90 days. It needs to shorten the maturity in order to gain access to its funds in 90 days around mid-June. For simplicity, we assume that the short-term yield curve is flat with all rates at 10% on March 20. For convenience, we assume a 360-day year to match the price conventions for T-bills. The face value of the firm's T-bill is $10 million. With 180 days to maturity along with a 10% discount yield, the price of the bill is shown as P is equal to future value minus DY times FV times DTM by 360. So we're going to get a minus 0.01 times the same number times 180, 360. We got a price of 9.5 million. Where P is the bill price, FV is the face value, DY is the discount yield, and DTM is the days until maturity. Therefore, the 180-day bill is worth $9.5 million. If the yield curve is flat at 10%, futures yield must be 10%, and the 90-day T-bill futures price must be $9.75 per contract. Equals this number here. So you got $1 million and 10% $1 million times 90, 360, 975. Starting from an initial position of a 6-month T-bill, the firm of our example can shorten the maturity by selling T-bill futures for expiration in 3 months, as shown in table 6.10. On March 20, there was no cash flow because the firm merely sold futures. On June 20, the 6-month bill is now a 3-month bill deliverable against the future. In table 610, the firm delivers the bills and receives the future invoice amount of $9.79 million. Although we've assumed that the futures price did not change, this does not limit the applicability of our result. No matter how the future price changed from March to June, the firm would still receive a total of $9.75 million. We presume that this will happen in June instead of over the period. The company has successfully shortened the maturity from 6 months to 3 months. And then lengthening the maturity. Consider now on August 21st, an investor who holds $100 million face value T-bill that matures in 30 days on September 3rd, 20. Plans to reinvest for another 3 months after the T-bill matures. However, fears that interest rates might fall unexpectedly. If so, should be forced to reinvest at a lower rate than is now reflected in the yield curve. The September T-bill futures yield is 9.8%, the same as the rate on the current investment. The manager finds this rate appealing and would like to lengthen the maturity of the T-bill investment. The manager knows it's easy to lengthen the maturity by buying a September futures contract and taking delivery. The manager will then hold the delivered bill until maturity in December. With 9.8 discount futures yield, the maturity of the delivery unit is 975.5. With 100 million being available on September 20, investor knows he will have enough funds to take delivery of, it's like 100 million divided by 975, 102.51 futures contract. Therefore, she initiates the strategy presented in 611. On August 21st, She held a bill worth $99,183,333, assuming a yield of 9.8%. With the transaction of Table 611, he had no cash flow on August 21st. With the maturity of the T-bill in September, the investor received $100 million and used almost all of it to pay the futures delivery. We assume he invested the remainder, $499,000, at a baked discount rate of 9.8% for 3 months. In December, full proceeds will be $102,511 from an investment that was worth $99,183,333 on August 21st. This gives her a discount yield of about 9.8% over the 4-month horizon from August to December. Got all that? It's a lot of moving parts, but you just have to think forward. Look at the mechanisms. Look at the process here. I'm just going to go ahead and review this quickly. So we have this transaction to lengthen maturities, hold the 30-day T-bill with a face value of $100 million, wish to extend the maturity for 90 days. Buy 102 September T-bill future contracts with a yield of 9.8%. This is in August. She buys 102 September T-bill future contracts with a yield of 9.8%. The 30-day T-bill matures, receive $100 million, invest $499,000 in a money market fund at 9.8%. Accept delivery on 102 September futures paying $99,501. December 19th, T-bill received on September futures mature for $102 million. Received proceeds of $511 from investment, so $511,255. Notice that the transaction locked in the 9.8% on the futures contract. In this example, this happens to match the spot rate of interest. However, the important point to recognize is that lengthening the maturity involves locking into the future yield, no matter what the yield may be. Thus, for the period covered by the T-bill delivered on the futures contract, investment will earn the future yield at the time of contract. Read it. Reread it if you need it. Brad Williams, Frugal Finance. See you soon.